You can follow all the right money rules. You save, you invest early, you work hard, and still, that financial scoreboard never moves. I went from working as a janitor to managing billions of dollars at Goldman Sachs, and I learned a hard truth. Money doesn't care about the rules you were taught. The standard advice society gives you is perfectly engineered to keep you a reliable employee. Wealth operates entirely differently. It ignores arbitrary rules and strictly follows absolute economic laws. Those laws are built on an architecture of three specific forces: momentum, structure, and asymmetry. To escape the endless cycle of the middle class, you have to abandon the old playbook and rebuild your financial decisions entirely around these three pillars. This chart compares two opposing financial strategies. The jagged wave represents speed, like frantically flipping houses. You put money in, do the work, and pull cash out. The smooth, rising curve is time, buying a property and simply holding it. Money loves speed, but wealth loves time. Warren Buffett weaponized time better than anyone in history. From 1965 to 2024, Berkshire Hathaway compounded at nearly 20% annually. He bought high-quality companies and held them indefinitely, hitting a total return of 5 million%. Time creates the foundation for growth, but it can take decades to reach a critical tipping point. Leverage is what accelerates that curve. By using borrowed capital or existing assets to control a larger position, you make the passage of time work on a much larger scale than your own savings would allow. Elon Musk demonstrated this during the Twitter acquisition. Selling his Tesla stock would have triggered an immediate tax bill and effectively shrunk his net worth. Instead, he pledged his existing shares as collateral for a bank loan, using the momentum he'd already built to acquire a new multi-billion-dollar asset. Momentum is not working faster to scrape together cash. It is engineering a setup where time and leverage quietly multiply your net worth in the background. The second force is structure. In the financial game, the person who writes the check controls the outcome. This chart breaks down the Forbes 400 list, and the math is unforgiving. Exactly 0 people made it onto this list purely through earned income or a salary. The vast majority of the ultra-wealthy are strictly buyers and builders. Founders like Mark Zuckerberg understand structural advantage. They don't optimize for a paycheck. They buy, they build, and they continuously retain complete control of the assets they create. High earners easily get stuck here. They chase a stable income and mistake it for wealth. But cash flow only pays for your current lifestyle, your house, your car, your bills today. Equity is the ownership that secures your freedom tomorrow. Mastering structure requires a complete shift in your objective. You have to stop trading your time for monthly cash flow and start acquiring pieces of the underlying machine. Notice how this diagram maps risk in venture capital. A firm makes 5 investments. 4 of them completely fail and go to 0, but the 5th delivers a 100x return, instantly dwarfing the previous losses. Risk and reward do not scale evenly. Billionaire investor Ray Dalio approaches this with a strict mathematical framework. Most amateurs try to increase their potential return, bringing massive risk along with it. The true objective is to artificially drive the risk down while keeping your return exactly the same. Wall Street tells retail investors to spread their money completely thin across the market. Every wealthy person I know does the exact opposite. Diversification is simply a hedge against ignorance. If you don't fully understand a business, you spread your bets. But if you have deep insider knowledge and operational control, like Bill Gates building Microsoft, you concentrate your capital. You put your eggs in one basket and you watch that basket closely. Asymmetry means you aggressively protect your core wealth from catastrophic failure. You cap your downside so you survive, and you swing for the fences only when you have a massive unfair advantage. Knowing these laws is entirely useless if you don't run your capital through them. Before making an investment, run it through a strict filter. 1. Can this compound over time? 2. Who holds ultimate control? 3. If it fails, do you get your money back? 4. Is the upside actually larger? 5. Can you explain what could go wrong? Filtering every financial decision through these 5 questions forces you to move past the rules of an employee.
It ensures that every dollar you invest is placed where time, structure, and asymmetry are working in your favor.